video. Now, we said term insurance really comes about in the mid-1500s. This term insurance is available today in a variety of forms. You'll find not all term insurance is priced the way that original term insurance was priced. That with term insurance, we can have still today some 1-year renewable term products. A 1-year renewable term product means that I pay a premium, I'm covered for 1 year. At the end of that year, if I want, I can choose to continue paying a premium. It'll be a little bit higher premium, but my coverage will continue. Because the policy is renewable, I don't have to go back to the insurance company and provide new evidence of insurability. So 1-year renewable term, not all that common an insurance product today, but you'll see this idea, this yearly renewable term, comes up several times throughout the material. And really what it makes reference to is any kind of pricing structure where you know that your price is going to increase year over year over year. It's not really ideal for most people buying term insurance. Most people who are buying term insurance have a need that might go on for a longer period of time. So we might sell somebody a 5-year renewable term policy today. In a 5-year renewable term policy, we're going to combine 5 of those years together using kind of a similar concept to the original development of whole life insurance. And then at the end of that 5 years, you will know that you can renew your insurance. It is, after all, a renewable product. However, your price is going to increase according to the average mortality between whatever age you decide to renew at and the point 5 years out from that. 5-year renewable term used to be a fairly common product, but we don't even see a lot of 5-year renewable term today. Instead, we're seeing with more frequency 10 and 20-year renewable term products. And these are generally associated with covering off some sort of a debt, such as a mortgage, covering it off for a certain amount of time, 10 or 20 years. Your coverage won't run out after 10 years or 20 years, but the cost will jump a fair bit. So this 10 or 20-year renewable term gives somebody the ability to fix their cost of insurance for 10 or 20 years, whatever it happens to be. You'll even see some 30-year terms sold today, at which point the client can make the decision to carry on for another 10 or 20 years or can simply end their policy, whichever happens to be appropriate for them. Now, these term policies are typically going to have some sort of an expiry built in. So yes, you might buy a 10-year renewable term and you might want to continue renewing at the end of each term, but you will find normally some sort of an expiry date here. So you might find a 10-year renewable term to age 75, for example, or to age 80. And these are not the only circumstances that you can find yourself in, but these are two fairly common situations. Renewable to 75 would mean that at your 75th birthday, you would no longer be able to renew, and whatever insurance you had in force at that time with respect to this policy would end. So a 10-year renewable term policy means that every 10 years up until you hit age 75, your premiums are going to increase. Once you hit age 75, that's it. Coverage ends. And because it's a term policy, you'll have nothing to show for it going forward. You won't get your premiums back in most cases, although we're starting to see some innovation on that front. But you won't get your premiums back. It's really like you rented your insurance for that period of time. Now, another type of insurance that we see used today came about in the early 1980s. And this product came about because there are some limitations with whole life insurance. Whole life insurance is a pretty robust product and it has some very good features. But one thing that it doesn't really do, it does not take into account fluctuations in the market. There is this investment component, and as I said, it's growing, but the insurance company needs to manage their risk here. They know that they've taken on so many insureds, they've sold so much life insurance, and they can predict based on these mortality tables, which are very accurate, they can predict how many people are going to die at a given point. So the insurance company has a degree of certainty around this policy reserve. And their investments with the policy reserve are generally going to be guaranteed investments. Now what that means for you as the policy owner is that you're not going to have investments here that fluctuate depending on the markets. This is good when the markets are down. People who own whole life policies over the last 2 or 3 years were very happy about them. But when the markets are good, whole life policies don't react to those situations either.